Welcome to my take on the stock market. Well, the market, as you know, in October dropped its 20%. The reason it dropped because of the rejection of 2.5% interest rate hikes. The problem is when you have so much debt, when you have a historic national debt, you have historic household debt, you have historic auto debt, credit card debt, you have the twin deficits. Those are both historic, both the trade deficit and budget deficit. All those heavy deficits, all those debt, that makes it problematic for interest rate hikes because debt is very sensitive to rate hikes. That's why we had the drop. So one's going to ask, well, why did it go back up? We have the same interest rates. Good question. Because it was engineered to go back up. They used the narrative almost every day for the last 12 weeks. We got a successful China-U.S. trade agreement. And that was pushing the market up. That was the rumor. And now they started to sell into the rumor. And that's why you're seeing us stop the rally around 2,800. Now, during this whole rally, during this 12 weeks of China-U.S. trade agreement is going to get done, surely, no problem. It's a done deal. During that rally, we have not seen, since 2008, so much, so bad, okay, economic numbers, the fundamentals. We are seeing all the red flags for another market crash. We're seeing red flags for recession. We are seeing the most important signals. We see the flattening of the yield curve. We see durable goods orders tanking. We're seeing housing starts tanking. We're seeing housing sales, both new and pre-owned, okay, not doing well. All those are just falling off a cliff. Now, those are red flags, plus construction spending, manufacturing, all falling off a cliff. But they've been able to override it with, again, that fake narrative that's been working. The trade deal with China is going to be great and it's going to be signed. Well, now there's a problem. China is saying they may not sign this deal. So the market has stalled. We still have the same 2.5% interest rate. Everybody's forgetting about that. All they've been doing is hold the president and his plunger team have been able to hold the market up. Just hold it there. They've been doing everything to keep it there until they come up with some catalyst to move the market higher. And the catalyst is going to be another QE. They're going to start printing money, and they're going to buy 10-year treasuries, and that's going to drive interest rates lower. And that's going to drive the market higher. So they think. Not going to happen this time because that gig is up because there's too much debt already on the Federal Reserve's balance sheet from the last time. They went from $400 billion to $4 trillion. Their balance sheet is topped off. What are they going to do? Add another $4 trillion? They started to sell those treasuries in hopes they could bring it down to $2 trillion. But the problem when you're selling treasuries to bring it down from $4 trillion to $2 trillion down back to $400 billion, so you have room to do more bailouts, it hasn't worked. Because every time you sell a treasury, the $4 trillion, you want to get that lower, you sell those treasuries, the rates go up. That means higher interest rates on the national debt, higher mortgage rates. So they're in a mess. The only thing that will push this market higher, the only thing that will make this market rally rather than a crash is they do another QE. So keep your ears open because right now that's what's coming down the line, QE. And what is QE? QE is a confidence game. QE, when they lower interest rates down to zero, it only benefits the very wealthy, who 85% of their income comes through the stock market. Main Street And those with 401ks get totally screwed. Totally screwed. It only helps the very wealthy. The middle class doesn't help at all. In fact, the middle class is disappearing. But keep your ears open. It's the quantitative easing is what we're going to hear. You watch. All right. So that's where we stand. In the meantime, we still feel that gold, the dollar should keep going down, and that's going to help gold prices go up. I will see you on the charts.